I think the takeaway is a confirmation of what was expected, which is, still strong trading revenue, continued momentum in capital markets, the investment banking side, M&A, equity, IPOs, et cetera. That's sort of building. I think you've seen some uneven results across the banks, JP Morgan the weakest. That happens, right? This is a business where timing, things can fall out of the quarter, things can get interrupted. We had a government shutdown in the fourth quarter, let's not forget. So things can kind of slip. That almost only accelerates the expectation for 2026 and even beyond into 2027, where the conditions out there for investment banking activity are really strong, right? Markets are near all-time highs, spreads are pretty tight, credit markets are accessible, confidence is generally pretty good, and I feel like we have a general sense of a higher ability to withstand certain pieces of volatility just in the world we live in. All of that sort of bodes well for investment banking activity going forward, and that's really bread and butter for Goldman Sachs. Morgan Stanley, on the other hand, has sort of shifted into that wealth business, which is steadier, and that's why you see really high return profile across that business. But things are good, and really it looks like better days ahead is the takeaway.
Neil, was there any weakness in any of the reports that stood out to you, any of the metrics that weren't as good as prior quarters?
Yeah, I mean, generally what we've seen has been equities outperforming fixed income, M&A outperforming underwriting. These are trends that you sort of expect in this type of environment. And when we look forward, I think, again, it's less about what has the fourth quarter provided and rather what is the expectation moving forward. And as we sort of look out and expect a broader M&A recovery than what we saw this year, which was really driven by a handful of mega cap type transactions, that really bodes well for investment banking as a whole. That flywheel spins, right? When you think about sponsor type clients, they want the dual track, right? They want to monetize via M&A or IPO. So having both those options is critical. That helps the breadth of the rebound. When we have large cap M&A and continued M&A, that sort of feeds debt financing for those transactions to take place. So a lot more of the same to sort of come moving forward. First quarter is seasonally strong for trading. Investment banking is sort of something that I think people are expecting to ramp moving forward. And so we'll be watching that closely. But, across the board, I think indicative of what's to come, which is growth.
Let's talk about BlackRock, speaking of growth, because the total assets under management rose to a record $14 trillion, which is just so big, it's almost hard to fathom sometimes. And we know that BlackRock is transitioning from this giant in the public markets, equities and bonds, to a giant in private credit and infrastructure as well. How do you see that reflected in the numbers?
Yeah, I think you're really starting to see it come in. And I think that's what's really encouraging is these transactions are, a year and a half old, and some of them have just recently closed. So they're really only now starting to flow through the numbers. But I think what you're seeing is, notwithstanding the backdrop of financial markets being very supportive as well to a firm like BlackRock, you're starting to see the early fruits of some of those transactions and what could be the future of BlackRock, where it's going to be powered more by the private markets franchise, despite the fact that it's pretty small in the grand scheme of things. In terms of that 14 trillion in assets, I think it increases $1 trillion each time I come on here every quarter. But in terms of that entire piece of the pie, private markets is still, a low single-digit percentage of AUM, but it's over 10% of revenue, right? So it's becoming a much bigger piece of the actual financial P&L for BlackRock. And that's the expectation moving forward. I mean, we're seeing flow and growth numbers that we haven't really seen from BlackRock before. And encouragingly, when you think of BlackRock, you think iShares, you think ultra low fee ETFs. These are on the complete opposite side of that. So again, sort of arguing for the push into private markets, it's positive to the fundamentals.